You're scrolling through YouTube, you see a thumbnail with a rocket ship emoji, and the title promises the next stock that's about to explode. We've all been there, right? But it begs a really important question. Should you actually trust stock advice from YouTubers? And this isn't just a casual question, you know? A brand new research paper decided to put this to the test, and what they found is pretty eye-opening. Turns out that hot tip from your favorite creator could end up being surprisingly costly. So there's actually a name for these folks: FinFluencers. You know, a mix of financial and influencer. These are the people on YouTube, TikTok, you name it, who are sharing investment recommendations. The term might seem a little new, but their impact is anything but small. Just how big are we talking? Well, the researchers behind this study analyzed videos from FinFluencers who, get this, have a combined audience of over 104 million subscribers. I mean, just let that number sink in for a second. That is a massive number of people getting their financial guidance from social media. Okay, so this brings us to the central puzzle here. If the data shows that a lot of their advice leads to, well, not so great outcomes, why are they so popular? Why do we all keep watching? What makes them so incredibly persuasive? Well, the answer seems to lie in this fundamental mismatch between what our brains are drawn to and what we actually need for a good investment. We're wired to respond to things like confidence, emotion, and somebody who sounds absolutely certain about the future. But what does a sound investment actually require? Pretty much the opposite. Cold, hard financial data, risk analysis, and just plain old due diligence. It's in that gap that persuasion completely overpowers performance.
And this leads us to the most paradoxical, kind of mind-blowing finding from the study. And I'm quoting here: underperforming influencers present their recommendations with greater conviction. Think about that. The people whose advice is actually worse are the ones who sound the most sure of themselves. It's not the quality of their analysis that hooks us. It's the performance of their conviction.
So how in the world do you scientifically measure something as subjective as conviction? I mean, it's not like you can use a thermometer for it. To figure this out, the researchers had to build a pretty unique tool to really put this idea to the test. And this was a huge undertaking. They built something they call the VideoConviction dataset. It started with gathering nearly 300 Finfluencer videos. Then, and this is the wild part, human experts spent over 450 hours manually watching and tagging every single recommendation. From all that, they created a benchmark to see if an advanced AI could even understand what was being said. This is some serious, rigorous work. So what happened when they pointed an AI at these videos? Well, the machine did great at spotting a stock ticker, like AAPL, no problem there. But it really struggled to figure out if the person was actually saying buy or sell. And as for judging their conviction, the AI was totally lost. It just proves how much of this communication is based on human nuance that machines just can't grasp yet. And here's the big takeaway from that experiment. Even sophisticated AI models get confused. They can't tell the difference between someone just casually talking about the market and someone giving an explicit, "you should buy this now" recommendation. It shows that so much of this advice is delivered through these subtle human cues that aren't easy to pin down in code. Okay, so we know conviction is powerful and it's hard to measure. But let's get to the million-dollar question, right? Does the advice actually work? It's time for the verdict. Finfluencers versus the market in a head-to-head showdown. And the results are in. If you had a strategy where you just bought every single stock they recommended, you would have had an annual return of just under 10%. Now that sounds okay, until you compare it to a simple S&P 500 index fund, which returned over 11% in the same period. So, on average, following their advice meant you were literally leaving money on the table. But wait, what about conviction? Surely the picks they were most confident about did better, right? And they did. They outperformed the low conviction recommendations. But here's the real kicker. Even the most high conviction picks from these influencers still failed to beat a basic QQQ index fund. So the bottom line is pretty clear. Number 1, following the advice generally means you're going to underperform the market. Number 2, a massive 80% of all the stocks they recommended failed to beat the QQQ index fund. And most importantly, high conviction from an influencer offers absolutely no guarantee of high returns. But the story doesn't end there. The researchers decided to explore a fascinating and frankly kind of hilarious twist. A strategy so counterintuitive, it almost sounds like a joke. They called it the inverse YouTuber strategy. The question they asked was simple but profound. What would happen if you did the exact opposite of what they recommended? So when they said buy, you'd sell or short the stock. And when they said sell, you'd buy. Okay, prepare yourself, because this is the most shocking finding in the entire study. A strategy of betting against the FinFluencers would have yielded an annual return of nearly 18%. That doesn't just beat their own picks, it completely crushes the S&P 500. This research suggests that, on average, they were a reliable contrary indicator. Now, before you run off and bet your life savings against your favorite YouTuber, there is a huge catch, a really big one. While the return was much higher, the risk was also way, way higher. We can see this with the Sharpe ratio. It's basically a score for how much return you get for the risk you take. A higher score is better. This inverse strategy scored a 0.41, while the plain old S&P 500 scored a much better 0.65. This means those higher returns came with a much bumpier and more unpredictable ride. So if there is one thing, one crucial point to take away from all this data, it's this. A confident delivery does not equal sound financial advice. That feeling of certainty you get from the person on the screen, it's a powerful tool of persuasion, no doubt, but as this research shows, it has almost zero correlation with actual investment performance. And that leaves us with one final question to ask yourself the next time you're watching one of these videos. Are you investing in their analysis, or are you just investing in their confidence? Answering that honestly might be the best financial advice you could ever get.